Hello, and welcome to the Nasdaq Dorsey podcast for the week ending on February 7th. I'm Ian, joined again here by Miles. Miles, good to be back here. Got most people in the office today. Good week. A rainy day here in Richmond, though.
Yeah, rainy day. The walk over to the office, I come in and I'm absolutely drenched. I pretty much should have brought an umbrella, but I didn't. But certainly a busy week. Everything like you said, every people are in the office.
Yeah,
And
it's 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 nice to be able to walk to the office unless it's dumping rain.
yeah, exactly. And then it seems
And
like
then
a
you
five
can't.
minute
You're
walk.
not going to drive 2 blocks.
No, I'm not going to drive what? And hell, I don't even know where my car is.
That's
So
not
it's,
good.
could have gotten towed by now.
Oh
But
goodness.
it's busy week in the office, busy month in and busy week in the kind of opening start to the year, first podcast of February as well. So markets in general, would you believe if I told you the S&P 500 was up 3% so far this year?
Would you believe me if I told you that the S&P equal weighted has outperformed the S&P so far on a year-to-date basis?
Not, would you believe me if I told you gold was up 9% this year?
We can keep rattling down the list.
Yeah,
Guess how much Nvidia's down? I think that's
that
yeah.
is an interesting one.
There's
Exactly.
a lot going on. A lot we can definitely dive into, but there are a couple areas I think in particular that we wanted to hit on. So first being some of the news around tariffs that have gone on over the past week. I mean, it's great to wake up in the morning, check my Twitter feed to see how the markets are going to be doing. It's been a lot of fun over the past couple of weeks. I'm sure it will be for the next 3.5 years. But in the other aspect that isn't maybe affected as much on the news front is some of the model updates that we had this week. We had our seasonal model evaluations. Our fund score method models were evaluated at the beginning of this week. Some notable trends and things that we saw from some of those evaluations. You know, those are pretty popular, especially for those in the 401k space. Really easy to implement some of those strategies within a 401k framework. So we'll dive into a little bit of that maybe at the latter part of the podcast.
Okay. You want
Um,
to get started with the tariff stuff,
yeah,
internationals?
in the tariff stuff, I mean, in looking at tariffs were expected, right? I mean, I
Right.
think Trump ran on that platform. People were unsure, is this just a bargaining chip? Maybe it is, maybe it was, right? I mean, we saw the announcement come out late last week, I think late on Friday, and then more news about it over the weekend.
And then by Monday, they
And
were.
then by Monday, it was you got 24 hours before tariffs come into effect, right? Everything just happened in such quick order. Which I mean, in the tariffs specifically were 25% tariffs on all goods imported from Canada and Mexico, which is what was announced last week, late last week, and then an additional 10% tariff on goods from China. The Canada and Mexico tariffs never actually went into effect within 24 hours of Monday's action. So I think by mid Monday morning, like an hour after the market opened, Mexico's president announced that after she had a call with Trump, the tariffs got alleviated or pushed a month, right?
Right.
About 12 hours later, same thing in Canada. Probably not even that long. So China's the not as much of a deal there, but I mean, at least from the perspective of people being worried about, is this a bargaining chip? Is this actually going to go into effect? At this point, it's been a bargaining chip.
Right. Yeah, you sit across the table and you say, well, over the course of X billion dollars worth of goods and things like that, you're suddenly someone, I don't know who it is, but someone's paying more money across the board. That's an interesting thing, of course. And then there's retaliatory tariffs that impact and consumers elsewhere in the world and things like that. So yeah, seems to be a bargaining chip. What is interesting to us chartists is going to be the resulting price action. So of course, over the course of last weekend with the announcements of that kind of 25% tariff on Mexico and Canadian goods and 10%, like you said, for China. Over the weekend, markets, and this is last weekend, by the way, last weekend, markets took a bit of a dive. Or was it last weekend or
Domestic equity markets,
international equity? Or some,
international.
am I, maybe I'm just out of
No,
my
yeah,
head.
it was so the news came out later last Friday,
It
so
was last Friday. Okay.
a week prior to when the podcast is going to be coming out,
Yeah,
right?
the times were all
It's
confusing.
yeah, but I think pretty interesting to note. This obviously it's headline a lot going on in the headlines around this. A lot of people are like, well, what about the price movement within these different areas? Obviously, Trump's not doing these tariffs based upon the price movement of major ETFs from the countries.
Right.
Totally different
Or the
economic
matrix ranking.
regions, yeah, or the matrix ranking. But Mexico has been pretty bad from a country relative strength perspective
It's a good way to put it.
for a while,
Right.
right? So it's not like Mexico, potential tariffs from Mexico really could have hurt the equity assets within the country that much more. I mean, you had EWW, the broader iShares Mexico ETF, had shown a lot of strength for a while, had shown consistent improvement, really for like a couple of years stretch there, going from 2022 throughout 2023 into 2024, just kind of mostly steady up into the right. And then in May of last year, some political changes going on there in the country, and we got rattled off a string of 5 consecutive sell signals beginning in May of 24 through December, falling from a high of 71 all the way down to a chart level of 46.50. Pretty bad.
Right. And alongside that, you saw the fund score deteriorate. So we're talking about FSM models a little bit later on in the podcast,
Yeah.
but every fund is going to be associated with a fund score ranging from zero being the worst, to six being the best, based on a suite of technical attributes. And so again, six being good. From that time, I checked while you were chatting. EWW fell below a score of 3.0, which is what we kind of call as an important level in May of 2024. Since that point, it hasn't moved up back above 3. Since that point, EWW is down 27%. Emerging markets, EEM representative, down about 1%. S&P 500 up 14% during that time frame.
Wow.
So that kind of speaks to, if you were just following a switching strategy, just looking at that 3.0 threshold, at least from a performance perspective, that also kind of came in wings.
Yeah, and so I think that there's been a little bit of news over the past week or so that we did get the EWW go back to a buy signal in January. We got a reversal back up, or initial reversal down in the first hour of trading on Monday, and then reversal back higher on Tuesday. Formed a double top at that 50 point, one box away from giving a second consecutive buy signal, which would come with movement to 51. And then the fund would move back to a positive trend with movement to 53 from the current position. That sounds good. 2 consecutive buy signals if we get there, potential move back to a positive trend if we get there. But to your point, very weak fund score. This is like the fund didn't have that much lower to go. It's already down 27, could always go lower, but I was already down 27%, kind of heading into that move. And so we're just seeing this as a little bit more of a kind of near-term bounce. The more consistent improvement, maybe this is the catalyst for further improvement from Mexico. It swings higher and gives 5 consecutive buy signals, but we're nowhere near that.
The chart will tell us when that happens.
Yeah, exactly.
Right?
That's why we have the rankings. That's why we have the chart.
Yeah, and what we typically say, kind of maybe the take home for this part of conversation on Mexico and charting in general, is there's always going to be a headline, right? If we wanted to find a reason to go buy Mexico today, we could. If we wanted to go find a reason to sell Mexico today, or domestic equities in general, we could find it like this, right? Just Google something, right? And you could find 20 search results that tell you whatever you want to hear. What all of us are ultimately searching for, though, is price going up if we're long, price going down if we're short. And so using the charts to tell you that, using the fund score, using the trend that we're in, ultimately it's going to help us cut through the headlines, because again, there's going to be stuff, like you said, definitely over the next 3.5 years, as these kind of geopolitical relationships, let's call them, continue to play out.
Yeah, and I mean the next one was Canada on the list, right? I mean, I heard at a hockey game in Canada that everyone there refused to sing the national anthem after some of the. I mean, there's just some pretty crazy stuff going on.
Right.
But just from a price movement perspective, Canada is looked fine recently. It sits in the second quartile of our broad country matrix ranks. And actually, we've seen some notable consolidation from like a broader fund like FLCA, the Franklin FTSE Canada ETF, just kind of move sideways in the clear triangle pattern since November of last year. Kind of shot higher. Canada had been a little bit higher in the rankings, but had fallen off a little bit in last year, and now it's just kind of moved sideways. Yesterday's action reversed up, formed a double top. This fund's up 4%, out beating the S&P on a year-to-date basis. If it gives a double top at 38.50 on this chart, all of a sudden you got 2 consecutive buy signals, a triangle breakout. Not a bad looking name, not the best looking area in international equities by any means, but not a bad looking chart. It looks fine. Definitely an area that we'd want to wait for some of that continued positive confirmation. But you're a lot closer. Maybe another buy signal will kind of get you there over the hump to provide more positive confirmation that, hey, Canada's actually looks pretty good on this move.
I've got a question for you, actually, just in terms of maybe your analysis style. When you're saying, because I run into this when I look at charts a lot too, a lot of those times you're like, it looks fine. how do you, let's see if I can ask this appropriately. How do you deal with that type of stuff? Are you really just looking for like the creme de la creme, or do you like, is it really
Always.
just fine? Well, of course,
Yeah.
right.
Yeah.
Okay, so like a 3.33 from a fun score perspective, like this is something, even though it looks fine, that you're probably gonna pass on, or are you just gonna hold it? I mean, like what is
I think it
your
depends on a process. If it's an area that you're, I mean, so waiting for Canada to come back into, if you're using a score-based process, it's not going to be a highest scoring area, so we'll probably avoid that.
right,
But what is in international equities right
right,
now? Maybe we'll get into more of that in a sec. Yeah, so I mean, it wouldn't be, but if you're looking for to take a flyer on it, right? For those that are, um, seeing a breakout at 38.50 would give you some more positive confirmation. You got support right beneath it, 36.50
right,
and 36. Notable to look toward. Personally, it probably wouldn't be taking a swing on it,
right.
but I mean, we'll see how it shakes out. It's definitely going to look more favorable as an actionable area if it does give another buy signal there.
And I would agree in second. That's just good. I mean, we sit right next to each other in the office. We write the same research, but of course we're going to have slightly different views on things in general. So, always good to pick people's brains on exactly how they deal with these fringe type names. So interesting.
Yeah, and you mentioned in there and talking about Canada and talking about how we look for areas that are showing improvement.
Mhm.
I mean, so the final part of the tariff piece, wrapping that up, was Mexico. Obviously, I think Mexico, or sorry, not Mexico, China.
Right,
China's shown a lot of sharp movement over the past 6 months, to put it lightly.
right.
I would say it's looking more favorable now. We're seeing some strength building. I think we're going to kind of have to wait and see for
Right.
that space. But out of the countries that were mentioned, China does have the best longer term relative strength picture.
Hmm.
But China changes quickly,
It
so
moves very quickly.
very quickly, and so I think that's going to be a little bit more of a wait and see. Areas that don't necessarily move as quickly is going to be on the developed side. So
Hmm.
like Canada, right? I
Right.
mean, Canada's just when it's going up and to the right, it's just kind of steady, been up and to the right, which is something that gives me a little bit more weight towards that, I guess,
Hmm.
saying. But other areas within developed market equities kind of ride the same wave. When there is a consistent trend in a direction, especially on the developed side, it tends to kind of stick around a little bit more. It's not volatile as stuff on the emerging market side. And so our colleague Joseph put a nice piece in our research report yesterday talking about developed markets versus emerging markets and versus the kind of rest of the international space. And we're seeing basically areas in developed markets that have demonstrated positive relative strength have been continuing to expand on that relative strength,
Right.
right? Stuff that's been winning has been winning by more.
Right. And we talked before in the domestic space about this thing called the RS spread, the relative strength spread, which measures the dispersion between a basket of winners and a basket of losers. Now, again, we've talked about this from the domestic side. You can do this from an international side. You can do this from whatever.
Emerging,
Yeah,
developed, yeah.
exactly. And so we can throw up a chart maybe on screen or something like that that goes through that relative strength spread on the developed side of things. Going back to your point about how these RS winners things again, these trends persist on the developed side a little bit perhaps more calmly than on the emerging side.
Consistently.
Consistently, there you go.
Yeah.
That's a good word. And we've seen that spread on the developed side of things expand. That's going to be a good thing for momentum focused strategies on the developed side and internationally as well, but just specifically developed in this case.
Yeah, and we've seen stuff like Israel's up at the top of our country rankings right now. Some other countries have shown some more consistent improvement on the developed side in our broad country matrix rankings. But we have some ETFs that track the international space that have shown a lot more consistency recently as well than maybe some of their other international counterparts. Specifically, one of our longer running international funds that we partner with Invesco on, the Invesco Dorsey Wright Developed Markets Momentum ETF, PIZ, has shown a pretty consistent improvement over the course of the past couple of years. And this fund holds not individual countries, but individual securities and is country agnostic, but remains in the developed market space.
Right.
So it's looking at individual stocks held within developed markets, foreign developed markets, and it's going to hold the highest momentum stocks from the basket it's examining.
Right.
So the winners,
Hmm.
basically, that we're
Right.
looking at. And so those winners have continued to win relative to the broader space. more notably over the past couple of years, and certainly they did over the couple of years prior to that.
Oh yeah, I mean, you look at the default chart there, recently moving to some multi-year highs, 4 consecutive buy signals, nice stair-stepping pattern. It does check that box when you talk about the consistency of, expansion and things like that. So yeah, in terms of that, for exposure for that type of stuff, you can pick up, saying the momentum is strong within that international space. PIZ is something that you could, kind of look towards for that type of exposure.
And I think that it'll be pretty interesting. I mean, obviously, it's hard to talk about international equities without talking about the dollar.
Right.
We see the developed markets typically show a little bit more reaction to moves in the dollar versus emerging markets. And the dollar, it does tend to trend relatively more than other areas. Maybe not as much as it did over the past 2 years as it did to the 2 years prior to that. But when we're looking at the DX/Y, the dollar spot index there.
Mouthful.
It moved to a sell signal, falling from 110 down to 107 last month. Seen a little bit of back and forth action over the past couple of weeks, but is now reversed back down and is one box away from forming a double bottom at 107. If we get 2 consecutive sell signals there, that could be some further positive tailwinds for the developed market space in particular.
Yeah. Oh, yeah. I mean, you think about it again, we've talked about it in weeks prior, but a stronger dollar is a headwind for international equities. If
And commodities.
And commodities. If you do see, 2 consecutive sell signals, journey back down to that bullish support line, re-enter a negative trend, that would be more back and forth action for the dollar, of course, not as consistent in terms of its back and forth action as we've seen over the last 2 decades. But if you did see that continued downside action, like you said, developed markets see a little bit more of a price reaction,
at least in
there
near
to
to
that type of
intermediate
stuff.
term
Yeah,
potential
exactly.
there. Yeah. So it could definitely be some interesting places to look at. Well, I mean, we'll see if we get some further reactions around global international relations between you with
Right.
including
A
Europe,
tweet could change in
a
or like what
tweet
is it
or a
nowadays?
truther. I don't know what. Yeah. Whatever you're going to call it. But at least for now, things to be heading in the right directions for at least on the momentum side within developed markets there.
Right.
Other stuff that's been noticed on the momentum side, we're going to be seen in some of the fund score updates that we
Right.
saw. We didn't see much, I mean, anywhere come in international equities that didn't rise to the top, which I think is an important thing to mention. We've talked a lot about international equities throughout most of the podcast so far. Strength is still in the domestic space. Still ranks across the top of most of our rankings, and we saw that reflected in the individual score rankings too. And we're looking at some of the fund score models, but maybe it makes a little bit more sense, Miles, to what is FSM, what is seasonal, what is this evaluation we're looking at?
Yeah, that's a good question. The FSM framework, fund score methodology, fund score method, is essentially a system where we take a systematic system that is maybe a bit of a alliteration or whatever it is.
Repetition.
Yeah, sure. But we take a universe of funds, whatever it may be, and in some cases they're specific with different fund providers or anything like that. But point being, we've got a bunch of different models that follow this, and we take all of the funds. We take a look at that fund score I mentioned earlier, and we simply rank them from strongest to weakest
Right.
in that case.
Score
So
0 to
top
6.
exactly.
Right. 6 being the strongest, 0 being the weakest.
Yes. The fund score deal will then, or the model itself will then gravitate towards the top or the strongest areas, and it will evaluate on an FSM fund score model, seasonal quarterly basis. That's a lot of jargon, but it aligns with seasonally strong parts of the year, February, May, August, and November as a kind of look at. So it's slightly off kilter with traditional calendar quarters, but it's for a good point. Do you have something there? I feel like I'm
No. I think that's good. I mean, just the models are still a ranking based on momentum, based on relative strength. A couple nuances with those models, any of our matrix-based models, those rankings are completely dependent upon whatever is included in your matrix.
Good point.
So if you have a matrix of international countries, like we were just hitting on, Israel may be the top ranked thing in the matrix, but if every single thing in international equities is falling, Israel's just the best of the worst, right? The FSM models are a little bit different because the model still, you can only buy the stuff in the inventory that's going to come into the model, but the score of each fund, that score is 0 to 6, is independent of the inventory that we're examining. So if you're looking at a suite of T. Rowe Price mutual funds, or if you're looking at a suite of all cap global equity ETFs, the scores of each of those respective funds, both on the mutual fund and on the ETF side, it's going to be the same score if you go to the chart page for a particular fund or if you see it in the model,
Right.
which is important to understand. I think makes it helps make that a little bit more understandable for those that might be uninitiated to our process, right? It's just a score 0 to 6, sort it by score, still a relative ranking, higher the better, and the highest ones come into the model at each valuation point.
Good. That's a really good point of clarification because, like you said, it's really important. You look at a market environment like 2022 in domestic equities, something has to be, I like to put it, you said best of the worst, king of the losers, right? And so everything can be bad, you can avoid it. But the FSM framework helps kind of avoid that because essentially you can say, well, it's not necessarily agnostic or it's not necessarily dependent on that universe that it's looking at. It's dependent on the score, which is much broader reaching than the universe specifically.
And that's why this system works well, and especially in a 401k space, for those that might be looking for some kind of enhancement or solution or something like that, it's applicable very easily in different baskets of funds.
Right.
We just rank them, and then
Right.
it's a quick way to pick, okay, which fund should go in there. It makes a lot of sense for that space. I know I've used it in my particular 401k in the past, before having some other options open and available there. But with a lot of the models, for most of the models we have on the site, we focus on specific baskets. So I mentioned the rankings, the only stuff in the basket that's the only stuff that's going to go into the model. So we generally kind of separate it out on the mutual fund side by family. So we are most popular, some of our most popular models are T. Rowe Price models. So we take their mutual fund suite and we look to hold the top 5 funds typically at each evaluation. Also American funds, another very popular model family, done pretty well over the past year on the American fund side too. But again, same thing, take their basket of funds, sort it by the top 5. On the ETF side, we have generally a little tighter inventories. And so instead of holding 5, we're looking at 2 for 2 main models, at least on that side, right?
Yeah, no, and we can jump now into like actually what's in these things.
Yeah, why are we talking about them?
Yeah, exactly. Because we just evaluated the point is a lot of people are following them. So figure we talk about it on the podcast briefly. The main idea is what's actually in these things. Again, in general, we won't go into specifics about any one specific model, but in general, the main themes what we saw. No curveballs, really, like you mentioned before. We talked a lot about international equities, really no international exposure across the board. These models are just getting kind of continuously focusing on the growth focused areas or growth oriented models their funds within their universe. That was a mouthful. But the idea is we're just seeing continued focus on those growth names and continuing to tilt towards that. That's what's been working over the last 2 years.
Right. Yeah. If it ain't broke, don't fix it. Right.
Yeah.
I mean, but they're also, it's not only growth. It's not like a lot of those representatives. I mean, we do see a little bit of diversity in there from a domestic equity constituent perspective. But we're not seeing, like, for an instance, when looking at the US core model, QQQ got really close to coming into the model, but didn't quite get there. And so we remained in SPY, which the difference between QQQ and SPY has been notable 2 years ago, not as notable last year.
Right.
And so I think people are like, why does that matter? But so much. But if Qs had come into the model, that just would have pushed it further down the growth line, which having SPY come in there just kind of maybe a little bit more of a SPY cap weighted 500 being a balance. I don't know.
Right.
But the point kind of remains. But we saw consistency across the different suites. So the changes that we saw on the T. Rowe Price side were similar to some of the changes. Obviously, the funds are different, but similar in approach to the changes that we saw on the American Fund Suite. Similar to like we saw on the ETF side. It was just some of the financial areas and some of the other ETF models we have had one financial fund moved out and another bank's fund moved in, right? So a lot of consistency with these trades, which is at the end of the day good for our stuff. When we get a lot of churn, a lot of turnover with stuff, like you said, surprises coming in and out of the models.
Right.
Maybe that surprise ends up working out for the next year, but a lot of times those turbulent environments end up not being as good for momentum because they're choppy and the trends are not as easy to follow. They're just not established. When we get consistency, even when there are trades, but more consistent direction and movement, that it can be a much better environment for trend following because the trends are just more established.
Right. No, yeah, and I'll close it. We've been rambling for, well, this might be our longest podcast ever. But I'll wrap up with maybe one final thought, then give you the final word. The benefit of this type of stuff is its growth today, but it's going to remain tactical enough that if it needs to make a change in the future, it can do so. Right.
Yeah.
So we're not just focused, like you mentioned, it's not just growth stuff that's in there right now. But eventually, if if growth does continue or it does roll over, then it could pick up value. It could pick up other areas that would help protect it or shift allocation around.
Whatever floats to the top of the inventory is what's
Right.
going to come in, right? And so with these seasonal models, like you mentioned, it's going to be 91 days after the last valuation point, until the next evaluation is going to occur. So we're looking until the beginning of May,
Right.
unless things really go haywire. These models do have cash triggers to get you out. We won't dive into those. None of those were in danger of triggering
Right.
or triggering at this time. But those are evaluated at the end of each month. So the models are set there, at least on the seasonal side, until the beginning of May. So hopefully those trends continue to run.
And we will come back in May and probably talk about updates and changes.
We'll be back to talk about before then too. So we'll
Yeah.
but about FSM models in particular, yeah, certainly be sure to have there on the beginning of May. But you got anything else? Another model avenue that we should dive down?
No,
this
not
week?
today at least.
We won't make the people's ears bleed. Cool. Well, Miles, thanks for letting me hop on with you. And everyone, thanks for tuning in and listening to us this week. We'll be back to touch base on any other action.
Have a good one.